REITs can be an excellent alternative for investors seeking income from real estate. They are often high-yielding, easy to buy and sell, and come with low management fees. REITs offer a cheaper, tax-efficient alternative to holding individual real estate directly. Investors should look for REITs that have high, stable distributions. They should also ensure that the REIT has a diversified portfolio and is not overexposed to any market. REITs are an excellent choice for a stable source of income. Welcome back to the Ring of Knowledge, your trusted source of practical financial knowledge. Today's video will discuss a comprehensive guide to REITs investing. Here is everything you need to know. Why would someone invest in real estate investment trusts? Individual investors can earn a portion of the income generated via commercial real estate ownership through REITs. This can be accomplished without the individual investor's need to purchase commercial real estate. Real estate investment trusts, a guide to investing in them. Because real estate investment trusts, or REITs, are listed and traded on stock markets in the same way that exchange-traded funds, EFTs, are, the most effective investment method is to purchase units on a stock market. Individuals must have an account to engage in real estate investment trusts, REITs. The price of a unit in a real estate investment trust fluctuates in stock markets in the same way that an exchange-traded fund does. In addition to purchases made on stock markets, you can invest in real estate investment trusts through mutual funds. In the past few years, a few domestic mutual funds have also begun investing in REITs. Nevertheless, the actual exposure of these schemes to the real estate investment is relatively small at this point. As a result, the purchase of REITs units on the stock market is the only opportunity to obtain meaningful real estate exposure. There are numerous varieties of REITs. There is a list of the several types of REITs that are accessible across the world, each of which is determined by the type of real estate holdings. Retail REITs. Real estate investment trusts are expected to invest at least 24% of their total assets in commercial retail properties, including shopping centers and freestanding retail establishments. Residential REITs. Residential REITs are a specific type of real estate investment trust that owns and manages both prefabricated homes and apartment complexes that rent out their units. Healthcare real estate investment trusts. As the name suggests, the primary purpose of these trusts is to invest in and manage healthcare-related real estate properties such as hospitals, nursing facilities, retirement homes, and medical centers. Office REITs. REITs that primarily invest in and manage office space are known as office REITs. The rental payments made by tenants who have signed long-term leases are therefore the primary source of revenue for this kind of REIT. Mortgage REITs. In the case of these REITs, it is anticipated that approximately 10% of investments will be placed into mortgages rather than in physical real estate. How exactly do real estate investment trusts, REITs, make money for their investors? The purpose of every investment is to either increase the amount of money retained by the investor or to provide a reliable source of income. Unit holders in REITs receive both of these benefits due to their investment. The sale of REITs units on stock markets and the receipt of periodic dividends and interest payouts can provide investors with capital gains. Periodic dividends and interest payouts can provide investors with consistent income. Investors can also receive capital gains from the sale of REIT units. Dividend and interest payouts. Payouts of dividends and interest REITs take a portion of their net rental income and use that money to distribute dividends and interest to their shareholders. After deducting some essential costs connected to the administration and upkeep of the properties, this is the amount of money that a REIT is left with due to renting out and leasing out commercial real estate. A REIT's net income is calculated by taking a number of expenses and deducting them from its gross rental income. These expenses include management fees, depreciation, maintenance fees, and other similar expenses. Under the terms of the current SEBI mandate, real estate investment trusts are required to distribute at least 90% of the net rental revenue they collect to investors in the form of dividends and interest payouts. Capital gains. Gains on capital investment. Since REITs are listed and sold on stock exchanges, the price of individual units fluctuates according to both the REIT's performance and the demand that exists in the market. Positive performance by a REIT, similar to that of equity stocks and mutual funds, increases the price of REIT units. These units can then be sold at a profit, providing the investor capital gains. Next, let's take a more in-depth look at some of the essential benefits and drawbacks of investing in the individual units of a real estate investment trust. How to figure out fees and taxes. Investing in publicly traded REITs requires the services of a broker. In most cases, you can acquire a publicly traded REIT by purchasing its common stock. preferred shares, or debt security. There will be costs associated with the brokering of the deal. A broker or an investment advisor typically handles the sale of non-traded REITs. Fees paid up front are typically rather expensive for non-traded real estate investment trusts. The sales commissions and upfront selling fees are often between 9 and 10% of the investment. The value of the investment is diminished considerably as a consequence of these charges. Special tax considerations. In general, REITs are required to distribute at least 100% of their taxable revenue to their shareholders. The shareholders of a real estate investment trust are the ones who are accountable for paying taxes on any dividends or capital gains that they accrue as a result of their investment in the REIT. In general, dividends received from REITs are categorized as ordinary income and are not eligible for the lower tax rates that apply to other types of corporate dividends. Before investing in real estate investment trusts, you should talk to your tax advisor. How do you buy a REIT? Investors buy REIT securities through mutual funds, exchange-traded funds, or big stock markets like the New York Stock Exchange or the NASDAQ. REITs work like stocks, so you must do the same research before investing in them as you would with stocks. All types of REITs in the U.S. own assets worth more than $3.5 trillion, with stock exchange-listed REITs owning about $2.5 trillion. The U.S. Securities has registered these REITs and put them on a public stock exchange. Individual investors can buy publicly traded REITs just like any other stock. There are public REITs that don't trade on public exchanges, but they are registered with the SEC and are subject to the same disclosure rules as any exchange-listed stock. These REITs are much less liquid than those traded on exchanges, and investors may have to keep them for a certain amount of time before selling them. By pooling their resources, investors in an exchange-traded fund or mutual fund can gain exposure to real estate investment trusts. Remember that not all real estate funds invest solely in real estate investment trusts. To provide diversification, certain funds may also hold interests in other types of real estate. Categories of REITs based on their trading status. Public non-traded REITs. These REITs may be registered with the SEC, but they are not offered for trading on any exchanges. Instead, they can be purchased from a broker involved in public non-traded offers. One such broker is Fundrise, an online real estate brokerage. According to the Financial Industry Regulatory Authority, these real estate investment trusts are incredibly illiquid because they aren't publicly listed, and this illiquidity can last for durations of 8 years or longer. It is also challenging to assign a value to non-traded REITs. The SEC warns that these REITs frequently only evaluate their value for investors after 18 months after their offerings end, which might be years after you have already invested in them. Many online trading platforms, such as DiversiFund and Realty Mogul, allow investors to buy shares in publicly held but untraded real estate investment trusts. Publicly traded REITs. REITs are traded on an exchange similar to that of stocks and exchange-traded funds, and they can be purchased using an ordinary brokerage account. According to the National Association of Real Estate Investment Trusts, often known as NAREIT, the market currently has more than 200 publicly traded REITs. Real estate investment trusts that are publicly traded typically have higher governance standards and are more transparent. They also provide the most liquid stock, which indicates that investors can easily acquire and sell the REIT stock. This is significantly quicker than investing in and selling a retail property on your own. For these reasons, many investors exclusively buy and sell publicly traded real estate investment trusts. Private REITs. There are fewer disclosure requirements for private REITs, which may make it more challenging to evaluate their performance. Because of these restrictions, many investors find these REITs less appealing and come with added risks. Compared to publicly traded REITs, public non-traded REITs and private REITs typically have substantially larger account minimums, $25,000 or more, to initiate trading, as well as significantly higher costs. Because of this, private REITs and many non-traded REITs are only available to accredited investors, who are defined by the SEC as having the qualifications necessary to invest in more complex forms of securities. These investors have a net worth of at least $1 million, not including the value of their principal property, or their yearly income in each of the previous 2 years have been at least $200,000 if they are single or $300,000 if they are married. What are the pros and cons of investing in REITs? Owning real estate has traditionally been seen as one of the most reliable ways to build up a passive income stream. As a consequence of this, REITs and conventional methods of investing in real estate share a lot of similarities. They are a low-risk investment vehicle that provides investors with consistent returns over the long run. However, an essential benefit real estate investment trusts can offer: the vast dividends they pay out. REIT dividends pay more than most other assets, and this is true even when the risk of losing principal is taken into account. As a result of the need that REITs place on themselves to distribute at least 90% of their taxable income to their shareholders, REIT dividends are significantly greater than those of the typical company on the S&P 500. However, there are other dangers involved with investing in REITs as well. You will better understand REITs by watching the list of the benefits and drawbacks associated with investing in them. Compared to the majority of other income investments, real estate investment trusts offer more diversity, tax efficiency, and yield. However, they are susceptible to dangers specific to the REIT investment approach. If you understand these factors well, you may reduce the risk and yet benefit from owning or investing in real estate investment trusts. Pros: generally speaking, dividends have a higher yield, a diversified approach to managing your investments, and very liquid investment. The cons: payouts of dividends are subject to the same taxation as regular income. Interest rate fluctuations causes sensitivity, and certain kinds of qualities could present an additional danger. Avoiding fraud. Be careful of anyone who tries to sell real estate investment trusts that have not been registered with the Securities and Exchange Commission. Through the use of the SEC's EDGAR system, it is possible to validate the registration of publicly listed and non-traded REITs. Plus, you can use the EDGAR to investigate a REIT's annual and quarterly reports and any offering prospectus. Research public companies can provide additional information on how to take advantage of EDGAR. It would be best if you also investigated the broker or investment advisor that recommends buying a REIT for you to invest in. Assessing real estate investment trusts. It would help if you thought about these things when evaluating any REIT you come across. Number 1. A difference can be seen when strong management is in place. Look for businesses that have been in operation for some time, or at least have management with a great deal of experience in the field. Number 2. Many real estate investment trusts, or REITs, are listed on stock markets in contrast to traditional real estate investments. You gain the benefits of diversification that real estate provides without being committed to long-term investment. Liquidity matters. Number 3. Real estate investment trusts are investments that offer actual total returns. They offer significant dividend yields in addition to moderate long-term appreciation in their share price. Look for businesses that have a proven track record of providing both in a satisfactory manner. Number 4. Depreciation tends to exaggerate the drop in property value resulting from an investment. Therefore, while evaluating a REIT, rather than employing the payout ratio commonly utilized by dividend investors, consider the REIT's funds from operations, or FFO. This is defined as the net income minus the proceeds from the sale of any properties during the given year and depreciation. To calculate the dividend per share, divide the dividend per share by the FFO per share. The yield should be as high as possible. Number 5. Consider purchasing a mutual fund or ETF that invests in real estate investment trusts, allowing you to delegate the research and purchasing decisions to industry experts. What are the risks of buying REITs? Most of the time, funds that purchase REITs in bulk will be the ones to sell publicly traded REITs. After acquiring a sizable quantity of shares, they may sell some of their holdings to generate investment funds for brand new endeavors. Investors who wish to take advantage of the consistent and guaranteed income and dividends these publicly traded REITs provide are a substantial source of demand for these REITs. It is common for investors to prefer bonds because the value of publicly traded REITs tends to increase as interest rates rise. Because many publicly traded REITs are bond funds, the rise in interest rates might put downward pressure on the value of these REITs. If anything like this occurs, it can be difficult for investors to get out of their position, even if they wish to do so, because there is no secondary market for their investments. It is essential to remember that although many non-traded REITs aren't publicly traded on an exchange, they still have a widely accepted valuation. Furthermore, unlike penny stocks and alternative investments that aren't backed by any assets or liabilities, non-traded REITs aren't worthless and aren't as volatile. Investing in real estate investment trusts is a beautiful way to diversify your portfolio outside standard stock and bond investments. REITs can be attractive due to their high dividends and potential for long-term capital appreciation. The Internal Revenue Service mandates that real estate investment trusts, REITs, distribute at least 90% of their taxable income to their shareholders. As a result, REIT dividends are typically substantially more significant than the dividends paid by the typical stock in the S&P 500. Compounding with high-yield dividends is one of the best methods to obtain passive income from REITs, which is why it's one of the best ways. So that's all for today's video. If you like this video, click the like and the bell buttons. We'll have another video for you soon. Take care until then.